It started as a whisper. A few votes in Ottawa. A couple of announcements from Canadian ministries. Barely a mention on American news. But within weeks, the effects were undeniable. Canadian laws passed in early July 2025 are now quietly crushing entire sectors of the U.S. economy. 6 states are already spiraling, some losing billions in tourism, others watching their farms and factories collapse in slow motion. And while politicians argue on Capitol Hill, the real damage is happening in small towns, local businesses, and working-class communities. This isn't just about tariffs anymore. It's about a structural shift in North American economics, and most Americans still have no idea how bad it's getting. Canada, in a sharp departure from past policy, moved fast. It passed 3 major laws with surgical precision: a massive infrastructure funding bill, a repeal of the digital services tax, and permanent protections for its dairy supply management system. Each one, in isolation, might have seemed like routine domestic politics. But together, they are reshaping the balance of power across the border. The infrastructure law alone is funneling more than 16 billion Canadian dollars into new pipelines, railways, Arctic ports, and energy projects. This isn't just about logistics, it's about leverage. Canada is building the capacity to export oil, gas, and goods without touching the U.S. market at all. By redirecting its trade routes, Canada is no longer dependent on American ports or infrastructure. And that means American buyers, especially in border states, are being left out or priced out. But that's just the start. The second move was deceptively generous, repealing the controversial digital services tax. American tech giants celebrated. Meta, Amazon, Apple, and others immediately projected billions in savings. But behind the scenes, Canadian negotiators pivoted. With the tax gone, Canada demanded new trade concessions. And when Washington hesitated, Canada started tightening the screws in other sectors. It wasn't loud or flashy. It was calculated. Delays at customs. New regulatory hurdles. Discretionary licensing slowdowns. Quiet, but punishing. Especially for states reliant on digital trade and logistics. And then came the nuclear option, the permanent lockdown of Canada's dairy supply management system. Unlike previous periods of negotiation where quotas could be adjusted, this time, Canada codified its protections. U.S. farmers, particularly those in the Midwest, were effectively locked out. Not just temporarily, but structurally. For American dairy producers, especially those with large export operations in border states, it was like slamming a vault door on a major source of income. And the U.S. responded with retaliatory tariffs. But those moves may have come too late, or hit the wrong targets. Because while Washington escalated with steel and aluminum duties, Canada had already diversified. Oil was flowing north. Exports were shifting east. Supply chains were rerouted. And American states that depended on those flows are now scrambling to adapt. The first signs of impact came in Michigan. It didn't take long. Automakers in Detroit, Flint, and Dearborn began reporting supply chain disruptions. Aluminum costs jumped. Key Canadian components were delayed at the border. Ford issued an internal memo forecasting significant production bottlenecks through early 2026. Stellantis paused 2 hiring rounds. GM began sourcing parts from European partners, but at higher costs. Michigan's entire economy is tied to the auto industry. When a factory shuts down, it doesn't just hit the assembly line. It affects toolmakers, delivery drivers, lunch cafes, hardware suppliers, and even the credit unions that offer car loans to plant workers. The ripple effects are now becoming tidal waves. Tax revenues in small towns are drying up. Utility companies are reporting late payments. Local banks are tightening loan criteria. Michigan is already bleeding, and there's no tourniquet in sight. Ohio isn't far behind. With long-standing ties to Canadian steel and parts manufacturing, Ohio's industrial economy was always vulnerable to disruption. The state's cities, Cleveland, Toledo, Dayton, built their post-war recovery on robust manufacturing ecosystems. But those systems were built on affordability and just-in-time deliveries. With tariffs in place and Canadian suppliers rerouting, those assumptions are collapsing. Plants are scaling back to 4-day shifts. Suppliers are reporting contract cancellations. Small manufacturers are eating losses to avoid layoffs, but they can't hold out forever. Some have already defaulted on loans. Others are quietly liquidating. Meanwhile, rising fuel costs, caused by Canada redirecting oil and gas flows to its Arctic ports and European buyers, are making everything from logistics to local heating more expensive. Families are seeing heating bills spike just as inflation pressure builds. And businesses operating on thin margins are feeling every penny. Ohio is balancing on a knife's edge, and every new trade barrier tips it further toward recession. Then there's Florida. At first glance, you wouldn't think Canada's laws would impact the Sunshine State. But they have, dramatically. Canadians have long made up the backbone of Florida's winter tourism economy. Over 3 million visitors from Canada arrive each year, spending heavily in Miami, Fort Lauderdale, Orlando, and along the Gulf Coast. But following the July 2025 policy changes and retaliatory rhetoric from U.S. lawmakers, a soft boycott began. It wasn't announced in press conferences. It wasn't advertised. But the impact has been devastating. Canadian bookings are down more than 70% for winter 2025. Snowbirds who once rented for 5 months are now staying home, or heading elsewhere. Hotels are offering deep discounts with no takers. Vacation rental owners are defaulting on mortgages. Entire condo complexes in Naples are sitting empty. And beachfront restaurants, once packed every night, are cutting hours or closing altogether. But this isn't just about short-term losses. Florida's real estate market is tied deeply to Canadian buyers and renters. Without that northern demand, home prices in key regions like Sarasota, Cape Coral, and Fort Myers are softening. Investors who relied on steady rental income are now facing rising interest rates and zero occupancy. Mortgage delinquencies in tourist-heavy zip codes are ticking up. And lenders are getting nervous. If this continues into 2026, Florida could be facing a full-blown property crash in its seasonal markets, just as insurance premiums and climate-related risks are pushing costs to historic highs. Meanwhile, Wisconsin's dairy farmers are facing an existential threat. For years, Canada was one of their most reliable export destinations. High-volume, high-margin contracts supported thousands of family farms. But after Canada's supply management protections were enshrined into law, those contracts evaporated. Big cooperatives with political ties might find alternative buyers. But small farms, the heart of Wisconsin's dairy economy, don't have that luxury. Milk prices are dropping locally because there's no longer an export outlet to balance supply. But the cost of running a farm continues to rise. Feed, fuel, repairs, everything is more expensive. Some farmers have already sold off cows. Others are considering bankruptcy. And when a dairy farm folds, it doesn't just affect the farmer. It impacts grain suppliers, vet services, milk haulers, and even the schools funded by rural property taxes. Whole towns across northern and central Wisconsin are bracing for an economic winter, one that could last far beyond this season. Minnesota isn't escaping the storm either. Known for both agriculture and brutal winters, this state is getting hit from two directions. First, fertilizer. Canadian potash is essential to Minnesota's crop yields. But since July, supplies have tightened and prices have soared. Farmers are being forced to plant less or accept lower outputs. That means smaller harvests, higher grocery prices, and tighter margins. And then there's heating. Minnesotans rely heavily on Canadian natural gas and oil to survive sub-zero winters. But Canada's new energy independence drive means more of that supply is staying home or being rerouted to international buyers. Heating bills are rising, and utility companies are warning of further rate hikes before December. Low-income families, already struggling, are now choosing between food and warmth. Community organizations are overwhelmed. And rural areas with older infrastructure may see service disruptions if demand outpaces supply this winter. And finally, New York. It's easy to think New York is insulated from cross-border economic shifts. After all, it's home to Wall Street, global corporations, and a diversified economy. But 1/3 of the state lies outside the metro bubble. And those regions are starting to feel the pressure. Around 23% of New York's electricity imports come from Quebec's hydroelectric systems. That supply is now being throttled as Canada rebalances its grid and prioritizes internal development. As a result, electricity prices in upstate regions and parts of the city are rising. Businesses, especially those in manufacturing and data processing, are feeling the squeeze. Meanwhile, the repeal of the digital services tax has sparked a new front in trade negotiations. Fintech companies based in New York are reporting rising costs to comply with evolving Canadian regulations. For startups and VC-funded firms, this could mean consolidation or collapse. And in a city already facing high costs and post-pandemic instability, every job lost adds to the economic strain. This isn't just a regional issue. It's a national warning. Canada is no longer playing defense in its trade relationship with the United States. It's taking bold, strategic steps to prioritize its economy, its energy sovereignty, and its global export profile. And the US, still assuming dominance, was caught flat-footed. These 6 states are only the beginning. If American policy doesn't adapt, if diplomatic tensions escalate, more states will feel the fallout. The question isn't whether the trade war will escalate. It already has. The real question is, how far will it go? And how many states will be dragged down before Washington wakes up? So if you've watched this far, it's clear you understand how serious this is. Like this video if you've learned something new. Subscribe if you want to stay informed while most of the media sleeps on these seismic shifts. And leave a comment, is your state feeling the pressure? Are you seeing higher energy bills, empty hotels, or struggling farms? We want to hear from you. Because while headlines focus on politics, elections, and celebrity gossip, the real story is unfolding silently across state lines, written in unpaid utility bills, closing factory gates, and vacant beachfronts. Canada just made its move. The US has yet to respond. But time is running out.